Hi all, and welcome back to Money Manager's A User's Guide. I'm Nathan Peters. This week I thought it'd be useful to step back and turn the microscope around on me and my peers in the industry, the fund selectors. I'm just going to look at the facts, at the cold hard numbers, and see whether all the time, effort, and expense that fund selectors engage in actually adds value. You won't want to miss this one. So it's generally accepted that pre-COVID, the financial world was quiescent in macro volatility terms, monetary policy was historically accommodative, and being long most assets was the best way to invest. In fact, trying to add value generally wasn't rewarded versus market cap weighting schemes. So there was little demand for diversifying skill-based strategies like those that hedge fund selectors like myself dedicate their lives to sourcing. But of course now, when folks look back say over an Aussie fiscal year ending June 30th, in which equity risk is down negative 12.5%, credit risk is down 10%, and interest rate risk is down 8%, people tend to cast about for alternatives. Luckily, hedge funds broadly have done their job of protecting capital, falling less, about negative 6% on average according to Morningstar, but with hyper large dispersion between strategies and managers. This environment should be ideal for fund selectors like me, and indeed, the hedge fund portfolios I had been involved with at Fulcrum Asset Management actually rose 3% in the last 12 months. And that's fine, but 1 year is not enough to quantitatively assess whether this outperformance was the result of luck or skill. So I thought we should take the trailing 3-year returns of all the funds of liquid hedge funds that report their numbers publicly and set them against each other and the Venn factor lens. That 3-year period is a smorgasbord of factor gyrations with all kinds of macro environments included. A true gauntlet to test the best and biggest of us hedge fund selectors. Let's dig into the results. I guess I was surprised at the dispersion even within the public hedge fund portfolio world. The worst fund, Blackstone, lost almost negative 2% per annum at 11% volatility, while the best fund, Neuberger Berman, made 4.7% per annum with 5.6% volatility. Our own efforts at Fulcrum approximated the Sharpe ratio of Neuberger Berman at 0.7 Sharpe, but with a lower volatility of 4%. Okay, fine. So how was that money made statistically? Well, Fulcrum's hedge fund portfolio exhibited a low 0.2 beta to equities as designed, which makes up a large portion of the total risk given how volatile equities are, about 70%. But the 30% remaining is dedicated to diversifying skill-based returns, and that was productive, estimated to have returned over 1% per annum. This is super satisfying for me personally because I know that return is not replicable and unique for my clients, and for me as I'm a client as well. So how about the very well-funded, vastly better resourced competitors? What happened with them over the last 3 years? Well, from worst to best, Blackstone got decimated by a 0.7 beta to credit, which detracted almost negative 5% from returns. But alpha was still decent at positive 70 basis points. Credit Suisse detracted negative 2% per year of alpha, a hole which other exposures couldn't overcome. Franklin K2 was just positive, but that was due to more equity risk offsetting losses from credit and alpha. JP Morgan Multi-Manager had a similar equity stance and alpha generation, but long small cap and short equality factors both detracted from the total. And finally, Neuberger Berman uncorrelated strategies had the best return, but interestingly, that came from being long 0.3 beta to trend following, long the dollar 0.3 beta, and long FX carry. Alpha was actually negative for the best performing public portfolio of hedge funds. Simmer on that. They were positioned in the correct factors, but is factor positioning their professed skill set? If so, you wouldn't choose to do so via instruments in hedge funds. Just construct the factor exposures yourself. It's a lot cheaper. So, bottom line, do you need massive teams of researchers scouring the globe for hedge funds? That's debatable. Fulcrum's results were generated with a team of 2 dedicated people plus support. True, only the behemoths, Blackstone and JP Morgan, also generated positive alpha, but they were let down by disadvantageous portfolio construction. So next time the big brand names attempt to garner your investment with unassailable scale, think twice. and look out for the little guy. She may be working smarter, uncovering the gems hidden in plain sight, and building robust portfolios. That's all from me today on Money Managers, a User's Guide. If you found this content useful, please like, share, comment, subscribe, and hit the bell for notifications of future episodes. And remember, use your money managers. Don't let them use you. Thanks.